What's up everybody, GenExDividendInvestor here. In this video I'm going to show you how much dividend income that Warren Buffett's Berkshire Hathaway makes each year, and will elaborate on some reasons you might not be aware of as to why investors like companies that pay dividends. I'll also explain a little known fact about why Buffett invests the way he does, so I recommend you watch this entire video. So Berkshire Hathaway has two types of shares, Class A and Class B. The Class A stock price is 1,500 times higher than Class B.
Class B is around $232 a share, and Class A is around $350,000 a share.
That means if Berkshire ever decides to pay a dividend, which Buffett isn't a fan of doing, then the dividend paid for a Class B share will be exactly 1/1500th of dividend paid for a Class A share. Class A also has more voting rights, so each share of a Class A is worth 10,000 the voting rights of a Class B. That means you get 6.66 times as much voting power for Class A shares. Buffett owns a total of about 10,000 Class B shares, and he owns around 250,000 shares of Class A Berkshire stock. That means he owns around 15% of all Class A shares, and those shares are where the majority of his net worth is, which is currently valued at $87 billion. Class B shares came into existence because Warren wanted a lower priced stock that people could get into. Plus, before the two shares existed, some people were planning to start unit trusts and mutual funds that own Class A shares and market themselves as Berkshire lookalikes. Buffett didn't like that because he thought they would be charging management fees and even using misleading marketing practices to entice people to invest with him. Now, unlike the Class B shares, which split in 2010 and could potentially split again, Buffett has declared that the Class A shares will never experience a stock split because he believes the high share price attracts like-minded investors, those focused on long-term profits rather than on short-term price fluctuations. One final difference is that Class A shares can be converted into an equivalent amount of Class B shares anytime a Class A shareholder wishes to do so, but Class B shares cannot convert to Class A. If you watch the stock movements between both share types, you see they almost look identical other than the different price. Now let's take a look at a spreadsheet I put together of Berkshire Hathaway's holdings based on the latest available data and see which stocks have dividends and how much they pay into Berkshire each year. So I've sorted their positions based on market value. So number 1 is Apple, number 2 is Bank of America, number 3 is Coca-Cola, etc. And we see that Apple, he has 964 million shares of it, and at the price of $142 a share, that means there's a market value of $137 billion of Apple shares. That currently represents 50% of his portfolio because Apple has been shooting up, and that gives him a 5.7% ownership of Apple. Insane. And then we see even with the very low yield of 0.58%, that's paying Berkshire $791 million a year. And then we see Bank of America is number 2 in the portfolio at $30 billion, and they're dripping $743 million a year. And then his classic Coca-Cola is $19 billion worth, and at a 3.38% yield, it's dripping $656 million. And then rounding out the top 10, we have American Express, Kraft Heinz, US Bank Corp, Moody's Corporation, General Motors, DaVita Inc., and Wells Fargo. And then if we kind of look at his smallest positions down here, you see there's a total of 49 positions. And then we see 47th is VU, and then 48th is SPY, and 49 is UPS, which is dripping $239,000. So altogether, his portfolio's average weighted dividend yield is 1.43%, and it drips almost $4 billion a year. Amazing. So some of those positions are over 10% ownership in companies, but Buffett tries to avoid owning 10% or more of a company's shares, especially for banks. Because if Berkshire owned 10% or more of a bank, they could be reclassified as a bank holding company, which then causes them to have to deal with a bunch of new regulations and potential restrictions of what he could do. By keeping their ownership under 10%, they can say they own shares for investment purposes, and they're not part of a company's management. That being said, the Fed is relaxing some rules and may allow investors to own up to 25% of a bank without triggering the more restrictive rules. The other reason he likes to stay under 10% is due to an SEC rule called Short Swing Profit Rule. Very few people seem to know about that rule. It requires company insiders and anyone who owns more than 10% of a company's stock to have to return any profits made from the purchase and sale of a stock if both transactions happen within a 6-month period. So any profit you make, you have to give back to the company. This regulation came out in 1934 and was made to prevent insiders, who have greater access to information, from taking advantage of that information and make quick short-term profits. So let's say a CFO buys 1,000 shares of a $10 stock in February and then sells those shares in March for $20 for a total profit of $10,000, then that CFO would have to return the $10,000 to the company under the short swing profit rule. Thus, Buffett likes to generally stay under 10% of a company's shares so he doesn't have to deal with regulations like that, even though he's a long-term trader normally. He basically wants to be able to change his mind and sell something if he wants to, without having to give the profits away. Buffett also has a private stock portfolio worth $2 billion, and it makes about $40 million a year in annual dividends, so that's money that Warren can live off of because Berkshire stock doesn't actually pay dividends. But since he doesn't report the portfolio holdings in public filings, you can't get a 100% accurate picture of his smaller portfolio, which he himself said is just an afterthought to him because almost all of his focus on Berkshire. I've read that his personal portfolio owns things like J&J, Procter & Gamble, Walmart, and ExxonMobil, amongst others. Now let's talk about some reasons why you should consider companies that pay dividends when you're investing. I saw a document that said JP Morgan published a report in 2013 that found that companies that had a dividend and grew their dividend for 40 previous years had annualized gains of 9.5%, compared to companies that didn't pay a dividend who only had a 1.6% annualized return during the same 40 years. Amazing. I found another article that said according to Hartford Funds, more than 80% of the total returns of the S&P 500 index between 1960 and 2016 is attributed to the compounding of reinvested dividends. The same study found that companies that grew or initiated dividends experienced the highest return relative to other stocks since 1972, with significantly less volatility. In other words, companies that pay dividends offer the highest returns and the lowest risk. I found another useful article that said there are 3 big reasons why dividend stocks tend to outperform non-dividend stocks on average. Of course, there are always exceptions to averages like Amazon or Tesla. The first reason is that companies with dividends must keep cash on hand. The article said it's possible to manipulate income statements to make profits appear higher or lower than they actually are, but you can't fake cash, which is the most common form of a dividend payment. So dividends often boost investor confidence that the company is making the money they claim, and the more they boost their dividend, the more it inspires confidence. The next reason that dividend stocks tend to outperform non-dividend stocks is because companies with dividends demand fiscal discipline. What that means is that dividends add pressure to executives to ensure that any investing they do is good enough that it will continue to allow them to cover all their obligations, including dividends, which helps ensure a level of risk management in their activities and decisions. The third reason is because of an effect that's called dividend yield support, which slows bearish forces. What that means is when the stock market is crashing, strong dividend stocks tend to lose less than their non-dividend paying counterparts due to yield support, which basically means the more a dividend company drops, the higher their yield gets, and the higher the yield gets, the more enticing the stock becomes for people who want returns who are often more predictable. Thus, as yield starts quickly increasing, there's a higher likelihood that more people will jump into them, slowing or turning around the dividend stock that was crashing. This yield support phenomenon can break down if the yield gets too crazy high, in which case investors might worry that the dividend isn't sustainable and the company may not have enough cash to pay the dividend. It's almost like a dividend provides a safety net that can make you rebound up in some bear markets, but if the world is in a free fall, then you may still fall through that net. Another factor that influences yield support is whether a company has cut dividends in the past. If a company hasn't done that and instead has a history of continually increasing their dividend, then investors often see that as even more compelling. So now you know how much dividend income Warren Buffett's Berkshire Hathaway makes each year, why Buffett tries to stay under 10% ownership in his companies, and you have a better understanding why investors like companies that pay dividends, especially during down markets. Now, before I tell you a great story, I want to share that M1 Brokerage has a promotion running until the end of February, where if you click on my referral link in the description of this video and then open an account and transfer some cash into it and you meet the requirements, then both you and I get a free $30 deposited into our accounts. So if you open a normal individual account, you need to transfer in and invest $100, or if you open a retirement account, it needs to be $500 invested, all within 30 days from opening the account. If you're watching this video after February, then they're probably doing their default $10, which is still worth doing. Okay, now I want to tell you a valuable life story I found online. A young boy and a girl were enjoying a pleasant afternoon playing outside in their neighborhood together. The boy showed the girl his collection of beautiful, unique marbles. In turn, the girl showed the boy the handful of candy that she had just gotten for her birthday. The boy proposed that the two of them switch. He would give all of his marbles if she handed over all of her candy. The girl agreed as she found the marbles to be beautiful as well. The boy handed over all of his marbles but kept one, the most exquisite one of them all, in his pocket. The girl kept her promise and gave the boy all of her candy. That night, the girl was happy with the exchange and peacefully went to sleep. The boy, however, couldn't sleep, as he was up wondering if the girl had secretly kept some of her candy, just like he did with the marble. Moral of the story? If you don't give 100% in your relationships, you will always assume your partner isn't giving 100% either. If you want your relationships to be built on trust, you have to be a participating factor in that. Honesty grows your character. By being honest in relationships, you're holding your partner accountable to do the same. It allows both you and your partner to continuously think about your choices and how you can help or hurt your partner in your relationship. That reminds me of something I witnessed as a kid. We were loading our groceries after shopping into our car, and my dad noticed some laundry detergent that we'd set on the bottom of the cart but not in the cart that we'd forgot about paying for. My dad grabbed it and walked back into the store to pay for it. I'll never forget that moment, and it taught me that sometimes you can get away with something, but regardless, you should always do the right thing. And that reminds me of a quote from Warren Buffett. Honesty is a very expensive gift. Don't expect it from cheap people. And with that, I'd like to shout out my newest aristocrats. So thank you to Era, thank you to Cody Y, and thank you to Dorzak. As an aristocrat, they gain access to my new Dividend Spreadsheet 2.0 product that I use in videos, and to multiple private channels on my Discord, including one where I let people watch my videos before I release them to the public, as well as vote on some thumbnails I use in my videos. Finally, don't forget to check out my free Dividend Discord server where thousands of other Dividend investors talk 365 days a year, 24 hours a day. After you join, you need to verify your email, and then you need to wait 10 minutes and then click on the heart emoji, or you can just wait for me to authorize you. I put that 10-minute pause in to slow down bots. And for you rock stars who watched this entire video, please leave me a comment down below, I'd really appreciate it. Also, please consider hitting the thumbs up button, subscribing if you haven't yet, and click that bell notification. Thanks, and I'll talk to you again real soon.
I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.